channel. Today I'm going to be working on a new video which is called Crash the Market. So basically the economy, or the world economy, has been going quite cuckoo at the moment, or quite in a volatile period this time, because over the last year or so there's been talks about the rising cost of living, inflation, and rising interest rates, and so on. So anyway, this article I'm pointing to you will be it's from a site called Mish Talk. So it details about US and EU corporations demands for loans, which somehow being starting to fallen off ever since last year. So it looks like last year was like the peak of that period, and then now it's falling lower to this day. Now, okay, let's go a bit further. So this is just like some graph talking about the supply and demand for commercial and industrial loans. So these industrial loans are still rather healthy at the moment. I mean, I guess they need to spend on capture expenditure. So net percentage of domestic respondents have increased spreads of loan rates and over the cost of funds. So it looks like the difference between what the bank buys the loans, or through bonds to fund these loans, and how much money the small businesses and larger firms had to spend on loans. So okay, that's pretty much it. Now we're going to go through the domestic market for. Okay, so it looks like the demand for commercial industrial loans in the domestic market have just sliding to its lowest points ever since 2009 and almost close to 2001. Okay, so real estate. Okay, looks like real estate have peaked out already at the moment. So that's just demand for real estate loans. Okay, commercial loans have literally taken a dive this year, so which is interesting. So this is just like showing you what happened at the moment. So I'm going to go on to the stock market reports, or anything relating to the stock market. Before I do that, I just got to let you know this is not financial advice. This is just for educational purposes, and this is just personal commentary, or not personal commentary. This is just like general commentary. So it doesn't count your personal situation or any considerations. Just don't take this as financial advice. Now, this is a article from Lee Van Olsen, an Australian financial journalist. So we're going to the Australian side of it. So I'm based in Australia, and it just goes on about Australian dwelling values index. So ever since the RBA starts to raise rates back in May last year, and this is what happened to the Australian value dwelling index. So it looks like it did taken a plunge. Now it just start to creep back a little bit. Now, CBA new housing lending. So looks like this is what happens when the demand for loans started to collapse since 2020. So that's like during like the end of COVID. Now it's just like hasn't yet fully recovered much. So that's like last year's data. So this year's data could be similar, I think. Now, fixed rate loan expiry. So most fixed rate loan mortgages will expire between now and then next year. So that's just what the graph is suggesting. So okay, interest charge and schedule repayments. Oh, okay. So okay, this is interesting. So this is what I'm calling to the CBA credit stock. Okay, that's something which okay. So this is just basically like what's been passed on to variable mortgages. Okay, this is quite nasty. So anyway, that's about it when it comes to mortgages, loans, and interest rates. So let's get into the stock market chart. I'm going to have to refresh this to get rid of this silly banner. So this is just like hang on, I'm going to get rid of this anyway. So this just talks about the dollar index. So I'm going to go on to the chart of the S&P 500. So it's so far with the SP 500, it's been going up since last year from the 10th. So it looks like a really strong move. Then now recently up to late last month, now it's trending lower. Now let's change our perspective with candles. So okay, so it looks like we had like a couple bearish moments and a positive one, a bullish moment. Now it's like going for this sideways trading with the top a part of his like it can be considered. So it looks like it is kind of like you look at the MACD, it looks like it is kind of losing momentum at the moment as the market's starting to turn bearish in the short term. Now I'm going to look at the Australian index. So the Australian index were in a similar situation like the S&P 500. So far it hasn't done much ever since February. Like February was the highs of this year, and then now it just like went bouncing downwards in March, then just goes up again in April. Now it's trading sideways. So I know it was trying to call back some losses since February, but still it's trending sideways. So either way, I mean it's still rather bullish at this point, even though August and September are usually be the months that are weak for markets at the moment. Now let's look at the gold chart. So gold is basically like meant to show you like how much risk are in the global market. So the higher the gold price is, like the more troubling the global economy is. So it looks like it is trading a lot higher at the moment. So it looks like it's still there's a global volatility being crept up so far. So it looks like there is a strong move towards gold as a safe haven. I know there's Bitcoin, but still gold is like usually seen as the safest asset as for last resort. Now I'm going to look at the give me a second. Now I'm going to look at the ETF that's bet against the Australian stock market, the BB Oz. So that's by Beta Shares. So this is like the leverage leverage bear ETF. So this is basically just meant to bet against the Australian stock market if it declines or go through a correction or a crash. So it's been trading sideways. So it didn't quite actually make any major highs. So it's just making lower highs, and now it's going through this consolidation phase. So it looks like it bounced up a little bit. I reckon during this point in last month, I reckon they probably did made some sort of a bottom, but I can't be too sure about that because even though the bottom is was made back in February, but still I just reckon it's going sideways at the moment. But well, I wouldn't be too sure if it's going to go down further, but if it were to go down further, then that's probably the last chance for you to get into like a short position at this point. But honestly, I don't recommend buying this ETF if you know what you're doing. Now let's look at another ETF. Okay, this is to short the Nasdaq. Yeah, so therefore you can buy this ETF in the US and Australia, depending on which index you're going to be trading on. So therefore it's still on a decline since its peak from last year, 30th of December last year. Now it's going downwards. So okay, so I'm better just go back to the line chart. So it did make a bottom back in last month in the 19th of July. Now it made a lower a higher low. Now it's starting to creep up a little bit slowly. So looks like you look at the MACD, like it's starting to risen again. So I reckon there could be a potential bullish sign, depending how volatile the Nasdaq is. So just be careful what you're doing. Now I'm going to go to the Direct Asian chart, the Direct Asian daily S&P 500 high beta bear. So this is for the bears if they want to short the S&P 500. So the peak. Okay, so I guess the peak was a lot. Okay, let's go back to it. Oh, okay. I think the peak was back in last year when it was like $10. Or actually not $10, $12.50. Now it's just like going in decline. Okay, there's a bit of a tug of war between the bears and the bulls. So looks like the bottom was in roughly last month. I can't be too certain, but looks like there's potential double bottom at the moment. But now it's just starting to hover up a little bit. So I guess it's starting to stabilize at this point. So I wouldn't hold too much hopes on that because it may go lower or may just turn the other way around. But we're just going to have to wait for a couple of days just to see how it goes. So you look at the MACD, it looks like it's starting to cross over to the median line. So it looks like it's starting to creep up a little bit higher. Now I'm going to go to another chart. So this is the volatility index. Yep. So the VIX index meant to measure the amount of volatility. So looks like it did jump up a little bit from its low. So looks like signs of a global uncertainty is still happening. I mean, it's not from the peaks of last year in October where it's like at 33 points. So I just reckon it has a little bit a way to go. I mean, if it reaches up to 20, then that's probably an early signs of things to come, which sounds a bit scary for most of us. Now, let's look at another chart. So this is the TLC Treasury bonds. Okay, so it looks like it's still trading sideways and kind of like reached to the bottom just to maybe possibly retest that, but now looks like it hasn't done much at all. So if it does somehow reaches up to 120, then therefore looks like the stock market's in a bit of trouble. So let's see, look at the back to the peak of it. Okay, so the peak was at 2 years ago. Okay, now if you compare that to the peak back in during the pandemic, okay, that's quite a lot. Give me, sorry. I'm just gonna have to move this out. Oh, okay, here you go. So that's the peak during the pandemic on October the 3rd. So back in 2020, October, that's the peak, $169. So it has a long way to go. I mean, I wouldn't say like that's like a reliable indicator to tell like if the US is in recession, but usually recession would tend to start sooner before the chart will reach to its high. So at the moment, TLT needs to jump a lot more levels just to send a signal to the rest of the world that, oh my gosh, the US is in recession already. So that's my take. Now, this is the 2-year Treasury note. So, okay, so far like the yields is starting to creep up a little bit. So it looks like it's still the yields for the 2-year note is still higher than the 10-year one. So the 10-year one is like going in a similar pace. I mean, at the moment it's starting to uninvert. So therefore, if the 10-year bond yield starts to creep higher than over the 2-year, then therefore it's kind of game over for the US economy because usually if there's like a flight to government bonds, so therefore it would signal like most people who have money in equities will flow to government bonds. To be honest, most people probably won't even trade government bonds because government bonds are mostly traded by bond traders and large institutional fund managers. So honestly, I personally don't buy into government bonds or in the US government bonds. So usually we just tend to look at these treasury yields just to see if there's any signs of or a market meltdown. So if the yield of the 10-year is higher than the 2-year government yield bond, then that's a worrying sign. So anyway, I hopefully hope this video is helpful for some people. If not, just let me know. So this is just my first time doing a video about stock markets. Anyway, hope you have a good day. Have a good one.